Welcome to our tax talk at Evershed Sutherland. I'm Simon and I'm here today with Lars, our international transfer pricing expert in Germany. Lars, you wanted to talk to us today about recent developments in international law which has an impact on multinationals with local companies in Germany.
Yeah, thank you, Simon. So what recently happened at the end of January, I think it was January 28, is that the German Federal Ministry of Finance has passed 2 new circulars on the German license barrier rule. The license barrier rule, for those who are not familiar with the subject, is the German implementation of the OECD Nexus approach. That's action item 5 of the BEPS report from 2015. Which requires for royalty payments to be deductible in the country that there's sufficient substance at the level of the licensor.
That's interesting, thank you. But just in a nutshell, what does it mean, license barrier rule for a taxpayer?
Exactly. So let me just draw a little picture here. So if you have a German resident company in a multinational group, which is licensing in IP, let's say, from the US, from the UK, from Switzerland, what have you. Typically, what would happen is the licensor is asking for a royalty, an arm's length royalty. The licensee is paying that royalty and may deduct business expenses in Germany accordingly, as long as the royalty payment is arm's length. Now, what the OECD has suggested or recommended, and what has then implemented in Germany in 2017 by this license barrier rule, is that if the licensor does not provide for sufficient substance, then these expenses will not be deductible as an expense in Germany, the royalty expense.
Understood. Thank you. And now what's new?
Okay, let me briefly explain how the law works. So the law requires to apply, the license barrier rule requires to apply that first we have a preferential tax regime in another country. Mm-hmm. Typically, we refer to that as an IP regime, which we had in countries like Luxembourg, for example, for a long period of time. And then, that law for that IP regime or preferential tax regime, let's call it preferential tax regime, and I get to that in a minute. For that to apply, there must be no condition of substance in that particular country. If those 2 requirements are met, the license barrier rule kicks in and the expenses are non-deductible in Germany. So the question then is, what is a preferential tax regime? So it's not just the IP regime, it's any tax regime whereby you have a deviation of the tax rate from the standard rate in that country. Let's say the standard rate is 30% like it is in Germany. And you have a preferential regime according to which you would then only pay, let's say, 15%. That would be one requirement of a preferential tax regime. And then, in addition, it must be the tax rate under that tax regime must be below 25%, because that is what our minimum tax is.
Understood. So if the license barrier rule kicks in, maybe it comes to a double taxation, because in Germany the companies are not allowed to deduct the royalties from their taxable income, and they will be taxed abroad in the country of the licensor.
Exactly, and that's the problem here. We have these payments, we have these royalty payments, and they are obviously an expense for commercial reasons, right? But they will not be accepted for tax reasons, and that leads automatically to a double taxation. Of course, that is somewhat mitigated by the fact that you pay less tax, or that the assumption is that you pay less tax abroad. But as you may consider, that does not necessarily need to be the case. And actually, that's where these new circulars come in, because what we have now is the interpretation of this rule by the German tax authority. So the law was introduced starting January 2017. We had before one circular which referred to the list of preferential regimes, which is frequently published by the OECD, mm-hmm. by the Forum on Harmful Tax Practices at the level of the OECD. They issued this list not every year, but frequently. And that is typically, and again, this is again in one of these circulars, is adopted by the German tax authority. So if your regime is on that list, it is automatically assumed that we have a preferential tax regime. That is one part. The other part are the interpretations that the German Federal Ministry of Finance has now passed, whereby we have certain strict interpretations of this law. And I think one interesting factor is we are not only looking at IP regimes, we are also looking at non-IP regimes which have an effect on royalty income.
Oh, understood. So this means the law will be interpreted now, according to the latest decree, a bit stricter than it has been in the past. So yeah, I think this is an interesting takeaway. What else? What other takeaways do you have for our viewers?
So I think just to stick to this particular point. So for example, it is expressly said in that circular that, for example, preferential tax regimes, which we had in Switzerland for principal companies, for principal holding companies, that they are still subject to this license barrier rule. Just an example, they've been abolished a few years ago, I think in 2019. But still, just to give you an idea how this works. So even if you have a tax regime which allows for a lower tax rate for any sort of company which falls into that area, you might still be in this license barrier rule. And that is something that is interesting, because what has been discussed for a long time is whether the foreign derived intangible income regime in the US is actually subject to the license barrier rule, and whether it constitutes a preferential tax regime. So the OECD, and I think that's a little bit political, does not really want to commit to that, but the German tax authorities now expressly said, well, we will look at it, and we keep all cases open and pending for as long as possible, because we may reinterpret the law accordingly.